Tax-free dividends and the ROBS. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. Welcome to another episode of AdBits. On today's podcast, the advantage of using a Rollover Business Startup Solution, or ROBS, and how you can get tax-free dividends out of the structure. So on this podcast, the ROBS solution will be discussed, and I will also talk about the use of dividends and how one could use dividends in a ROBS setting to potentially generate tax-free returns to the 401k owner or shareholder. So if you have a ROBS, or you're thinking of using a retirement structure like the ROBS to invest in a business that you will operate, the use of dividends, which I will explain in a moment, could be a very, very tax-efficient way of allocating more tax-free funds to the 401k plan shareholder. So let me start with what the ROBS is. Then I'm going to go into discussing what a C Corp is, what a dividend is, and then put it all together and explain why using the tax-free dividend strategy is so advantageous with ROBS. So the ROBS is Rollover Business Startup Solution. It is a name. You're not going to find that name in the tax code. What the ROBS is basically the purchase of what's known as qualified employer securities. Okay, so under the tax code, everything you can't do with an IRA or 401k is found under 4975C as in Charlie. Now, if you can satisfy an exception to the 4975C prohibited transactions, they would be under D as in David. Now, if you satisfy an exception under D, the C rules don't apply. So there's a specific exception under 4975D13 that allows a corporation that has a 401k as its adopted plan, if the 401k buys the corporate stock, right? So if the company adopted a plan, so ABC company adopted the ABC 401k plan, and if the ABC 401k plan buys stock in the adopting employer, ABC Inc., that is known as qualified employer securities. And if that is done, then the transaction is not deemed a prohibited transaction under 4975C. Meaning, if you have a 401k that buys corporate stock, as long as it's stock of the adopting employer, so ABC Inc., ABC 401k plan, as long as ABC 401k plan buys stock of ABC Inc., and not ABC 401k buying stock in XYZ, because that's not the adopting employer. It's got to be ABC 401k and ABC Inc. That is qualified employer securities, and that is exempted from the prohibited transaction rules under 4975C. So if you look back at legislative history from the 70s, why was this put in the code? Like, what's the advantage? The belief is that Congress wanted folks who worked at companies, even executives, to be able to use their 401k to buy stock in the companies they work for. This was used mostly with publicly traded companies, but really since the 90s, this has been adopted for small businesses. So it's the same principle. Instead of General Electric or Ford, it's the small manufacturing or software or restaurant or bar or retail operation. So ROBS is really the only legal way one could use their IRA or 401k funds to invest in a business they control, right, 50% or more, and are employee without triggering the prohibited transactions. Now, if you're going to invest in a business passively and not earn any salary, then you could do it in a self-directed IRA. Or if you need less than $50,000, we can always set you up with a 401k loan solution. But if you need more than 50K, you want to be personally involved, you're going to own more than 50%, the ROBS, the Rollover Business Startup Solution, is the only legal way you'll be able to use your retirement funds to invest in a business without triggering the prohibited transaction rules. So how's it set up? Well, it's quite simple. First step is IRA Financial, set up a C Corp. I wrote a book on it. It's actually right here, Turning Retirement Funds into Startup Dreams. This book is, actually, I wrote it 5-6 years ago. I like it, really good book. It's not super long, but it literally goes through everything you need to know about how to do a ROBS. So in simplified form, what it is pretty simple. New corporation set up, not an LLC or S Corp, C Corp set up. C Corp adopts a 401k, right? That's the qualified employer security. You do a rollover of your former employer 401k funds or a transfer of IRA funds into the 401k tax-free. The 401k then buys the stock in the adopting employer. That's known as qualified employer security. That will get you around the prohibited transaction rules under 4975C. And there you can have other investors come in like yourself. You can earn a salary, and the money then goes from the 401k to the company. The company has the money to buy assets, inventory, hire people, start the business, and hopefully everything goes well. And there is a great business with revenues and retained earnings, profits. So this is when the concept of dividends come in. A dividend is when the company sends retained earnings to the shareholders. So what's a retained earning? Retained earnings are net profits after taxes, right? So if the company generates $100 in net profits, and net profits means revenues minus expenses. So you have $1,000 of revenues, $900 of expenses, you have $100 of net profits. The corporation pays 21% to the federal government. Let's assume no state tax in the jurisdiction you're operating. So you're left with $79. That's retained earnings, whatever's left in the company after expenses and taxes. So you have choices. The company has retained earnings. It can keep the money in the company. Okay, it could reinvest it, right? Hire more people or spend more on Google or buy more inventory. Or it could dividend it to the shareholders, right? Dividend is basically you take the net retained earnings in the company and you send it as a dividend distribution to the shareholders, right? If you own publicly traded securities, a lot of big companies will issue dividends, right? And it's a percentage of how many shares you have. And it's, let's say, 20 cents per share, $1 a share. Apple has big dividends, or some companies have smaller dividends. It depends on the growth model of the business. But in a privately held business, if the company has retained earnings and issues a dividend to the shareholder then pays tax on the dividend. Now, if it's a non-publicly traded company, the shareholder will generally pay ordinary income tax on the dividend, not capital gains, but ordinary income tax. If you get a dividend from a publicly traded company, that's generally treated as a qualified dividend and has a reduced tax rate of approximately 15%. But what happens if your shareholder is a 401k plan? We know a 401k plan is exempt from tax under Section 401 of the tax code. So company makes $1,000, right? Let's say makes $1,000 after tax and expenses. So there's $1,000 left after expenses and taxes. And now it wants to send the money back to the shareholders because the company has plenty of other money in the bank. If the shareholder was an individual like me and it issued me a dividend, I'm going to pay income tax, whatever my tax bracket is. But if the dividend's going to the 401k, which owns 99% of the corporation under our ROBS structure, then 99% of the dividend, the $1,000 dividend in this case, would go back to the 401k without tax. So what you're essentially able to do is use the ROBS, use your retirement money to fund your business, fund your startup dreams, tax-free and penalty-free, right? Your rollover into the 401k is tax-free, and then the 401k is going to buy the corporate stock. That's tax-free, penalty-free. The company is then going to use the money to grow. You're going to get a salary. You'll pay tax on salary. The company will then pay 21% corporate tax on the net profits, plus the state tax if there is any. And whatever's left, if the 401k is a primary shareholder, then the 401k is going to get a pro rata share of the tax-free dividend. And because the 401k is not a taxpayer, the retained earnings dividend is going to go back to the 401k without tax. So you're saving that double level of tax. Whereas if I was the shareholder, I'm going to pay a second level of tax. That's why a lot of folks like the LLC over a C Corp or an S Corp over the C Corp, because an LLC and an S Corp are pass through. There's one level of tax at the shareholder level. There's no 21% entity level tax. A Corp generally has two levels of tax, 21% and that shareholder dividend tax. But again, if the 401k is the shareholder, 401k does not pay any tax on the dividends. So you're basically eliminating that second level of tax. And now that money is in the 401k and it can be reinvested without tax, right? That $1,000 in our example, If it sat in the company and the company invested, it would keep paying 21% tax on it. If it was in the 401k, the 401k could buy stocks, it could buy real estate, it could buy Bitcoin, gold, whatever, and all the gains and income would be tax-free because it's in a 401k, not in a publicly or in a for-profit business. Doesn't have to be publicly traded. So that is the strategy, right? You use the ROBS to get tax-free, penalty-free use of the money. You invest in your startup dreams or your existing business. You fund it using your retirement money. You want to bet on yourself. You then are able to earn a salary and run your business, get a small business loan, however else you run your business. Then any of the profits you can leave in the company or reinvest in, or you can send them tax-free to the 401k pro rata, depending on their percentage of shares owned. And then the 401k can then reinvest those funds tax deferred or tax-free. So when you put it all together, the use of the ROBS and the dividend strategy in a tax-free setting is very, very attractive. And that's why the ROBS is a super attractive solution. Now, again, you don't have to use the ROBS if you're investing in a business. If you're doing it passively, you're not going to earn a salary. It's just like a side gig. Hey, I'm a CEO of a company, or I'm a software developer and I just want to invest in my buddy's business. You can do it. You don't need a ROBS if you're not going to be active and earn a salary. But if you want to be active or earn a salary, this is your baby, your business. If you need more than 50K and are going to control the business, the ROBS is the only way you're going to be able to do it. You don't want to just take the money out of your IRA and pay tax or penalty. Why would you want to do that? You're just going to lose 30 to 40% of the money. You might as well set up the ROBS, move the money from your IRA or 401k to the new 401k plan tax-free, and then the 401k could invest in the C Corp and do that tax-free, penalty-free. C Corp has that money to use to grow or start the business. You then get a salary, so you're exactly where you would have been otherwise, but you're not paying tax and a penalty on any transfer or rollover from your existing retirement account to the 401k. You're doing it tax-free, and then you can still run your business, earn a salary. But if there's retained earnings, profits after taxes, you can then dividend them back to the 401k without tax. Whereas if you own the business personally, you'd have to pay that second level of tax to get used to the funds. So especially if your 401k is Roth, it's very, very tax advantageous. So imagine you're over 59 and a half, the Roth's been open 5 years, right? The Roth owns the 401k stock, a Roth 401k. And now the company is making, let's say, 100 grand after taxes, net profits, net retained earnings. You can pull that money as a tax-free dividend and live off that money tax-free, because the dividend is going from the company to the 401k tax-free. Since it's a Roth 401k and the Roth's been open 5 years and you're over 59 and a half, you can then take those funds out and live off them tax-free. So you're able to use your money tax-free, penalty-free to fund your business, earn a salary. You do have to pay tax on their salary, but any dividends could be sent back and issued to the 401k tax-free. And if it's a Roth, you can then pull those funds out to live off them tax-free, so long as you're over 59 and a half. The Roth's been open at least 5 years. So it's a win-win, a really attractive strategy. That's why I wrote a book on the ROBS. We've helped thousands of people use their retirement funds to invest in their own startup dreams or help fund an existing business, from large, small. And then when you add the tax-free dividend opportunity, very, very, very tax efficient strategy. So that's it for today's podcast. Hope you guys enjoyed it. Hope this was enlightening and maybe spark some interest, whether you're considering starting a business or not. Potentially use a vehicle like ROBS to generate tax-free income and gains, and also use those funds to fund your business in a tax-efficient manner. I can't tell you how many times I've heard, and these are horror stories for me as a tax lawyer, where someone says, "Hey, Adam, I wish I heard about ROBS or read your book. I'm so dumb. I had 250 grand in my 401k. I wanted it to start a business. I'm 50 years old. I took it out. I paid ordinary income tax and a 10% early distribution penalty. So on the 250, I lost 45%. Nothing makes me hurt more. You just literally gave Uncle Sam 100K for no reason. So you don't have to do that. The ROBS will give you tax-free, penalty-free some money. You can still run your business the same way. You can earn a salary. And then if you have extra earnings, you can dividend them back up to the 401k tax-free. And then the 401k can invest them without tax, which is obviously very highly tax efficient. So thank you for listening. If you're watching on YouTube, really appreciate it. Definitely check out our amazing IRA Financial YouTube channel. There's thousands and thousands of videos and podcasts that you could learn anything and everything you need to know about self-directed retirement accounts, ROBS, solo 401k, alternative assets, new tax rules, BOI, whatever it is, it will be there. I promise. There's nothing we haven't covered. So appreciate your support. Thanks for listening. Have a great rest of your day. And I'll see everyone again next week. Thanks.